So what does this mean for investing? And I'm going to put titles to some of these different scenarios. So the great escape is actually slow growth. The jumping the shark is secular stagnation, which could turn into stagflation. So let's look at slow growth first. Equities, in a slow growth environment, is actually pretty good for equities because you have economic growth, you have interest rates moving up, but not by a lot. They can't move up unless the whole world starts improving. So it's actually a very good environment for equities. Now, I've got a neutral arrow on US equities only because, as I pointed out before, the US is the first out of the tunnel. It means the other countries from a relative perspective may be stronger. Not that we don't like the US equity market, we just think maybe some better value in some of the other markets. The slow growth scenario, however, is not very good for bonds because if you've got low coupon yields and interest rates rising, that's not a good environment for bonds, so that's a negative. Alternative strategies, gold, alternative strategies, they're designed to have a low correlation to the market, so de facto they should be neutral. I would say slow growth has a slight negative bias for gold. Secular stagnation is bad for stocks. Initially, if you say that you're going to continue to have lower and lower interest rates, that may be good for markets, but if we saw on the graphs with Japan and Europe, eventually you'll jump the shark and equity is going to go down. So you need earnings growth. You get that with economic growth. And so that's why this is a bad environment for stocks. It's not a bad environment for bonds, though. Even though they're, I would say, absurdly expensive already, if interest rates were to continue to go down, that would help bond yields. And again, neutral for alternative strategies, I would say a slight positive for gold because low rates are good for gold. Stagflation, look, it's bad for everything. Stocks, bonds, everything goes down, with the exception of gold. This is in the environment where you want to own gold. Now, as I mentioned before, we believe the slow growth scenario is the one that's going to play out, but the point I want to make is even though we believe it's slow growth, we're very cognizant of the other outcomes, secular stagnation or stagflation. And we want to have exposure to asset classes that are going to protect us if we have those different environments. So it's diversification is the key. And I'm only talking about equities, bonds, and alternative strategies. John's going to talk about some other asset classes that we think there are some opportunities in as well. But what I want to leave you with is diversification. That's the key in what I consider to be a treacherous and very uncertain market. So let's sum it all up. This is a picture, if you remember I said 3 people actually did escape, 2 of them by boat, and this is a picture of John Layton and Charles Bronson escaping by boat in the Great Escape. And we think that's appropriate because of the 2 scenarios, we think slow growth or the Great Escape is the one that we would key on. We think interest rates in this environment are going to stay low for longer, but gradually move higher. Oil and China are going to add volatility, but will hopefully be less of an impact than we saw last year. We like equities over bonds in that Great Escape environment, but again, as I said, diversification for us is the key.